So, Susan, you put together a very thorough email about interest rates, market conditions, and ways to do deals in a marketplace where the rates have gone up. Can you talk about that a little bit?
Sure, Brian. We're in a changing market right now with rates going up so drastically since last year. I think that we all have to get back to the basics and we have to explore different opportunities, not just a regular first deed of trust when we close. There's many, many different ways to close real estate transactions.
I love that. I was always taught to be creative. So, let's talk about some of those ways to do it other than getting a traditional first at 2.5%, which we know cannot happen today.
Well, it might be able to happen today.
Okay,
Okay,
let's
let's
talk
talk
about
about that.
that.
So, there are a lot of loans that were put on in the past couple years
hmm
that are both FHA and VA, and they're fully assumable to anyone that can qualify. Someone's going to have to live in the house,
Right.
and the interest rate that is there when they put it on is going to stay. People are going to assume that at the same rate that it was put on.
Fantastic. I don't think a lot of people know that or understand that. So thank you for that information. If it is not an assumable FHA, if it's a conventional note that's not assumable, what ways can a deal be structured in that environment?
Well, there's a couple other ways, but you definitely don't want to do this at home if you don't know what you're doing. There's a subject to where the loan stays in place. The buyer takes over the loan that the seller had. Seller's not going to be released of liability on that. They're still going to be responsible if the buyer defaults. So there's a little bit of risk in there. There's some other types if you want to really take off your training wheels, and that's the contract of sale or the all-inclusive deed of trust. Those are a little bit more technical. You definitely need to be dealing with a real estate agent that knows what they're doing and can explain the risk to both buyer and seller in those deals.
I'm glad you brought up the contract to sell and the all inclusive because, as you know, I was selling real estate when rates went to 18%. And the only way we were getting deals closed in that era was doing all inclusives or contract to sale. So, can you talk about the structure of a contract to sale?
Sure. In a contract to sale, title doesn't actually pass to the buyer at closing. The seller and the buyer enter into a contract, and what gets recorded is a memorandum of contract, so the house can't be resold. And when the terms of the contract are fulfilled, then the deed records to the buyer. The contract of sale wraps the existing seller's loan, so that stays in place and the seller remains responsible for that. The buyer's payments monthly go to an installment collection account, and then the payments are dispersed.
So, what would be the advantage of that structure for a seller?
The advantage of the structure for the seller is that in the event of a default, they can take the property back quicker than a typical foreclosure.
But it also allows them to transfer their property, technically,
Sure. Yeah, it
to
allows a sale.
somebody else in a market where sales are difficult and protects them, right? So there's an opportunity there to take advantage of that as a seller. If a seller's willing to offer that opportunity, that is unique and it will help them sell their property.
Correct. Yeah, that is a way they are protected in that in the event the buyer defaults, they can foreclose, as opposed, and it's a quicker foreclosure process than an all-inclusive deed of trust, which is another way to sell in this market.
Right. What would be the advantage to a buyer to do a contract to sell?
They get to buy the property at probably a little bit less of an interest rate than market.
Right. Huge advantage.
Yeah.
Huge advantage. When we were doing these and rates were at 18, we were doing contract to sales at 10 and 12%. So that
hmm
was a massive savings for a buyer at
hmm
that time.
Right.
Can you talk a little bit about the all inclusive?
Sure. In an all-inclusive deed of trust, title actually does pass to the buyer. So they are the fee title owner of the property. And then they will make payments to the seller, and the seller takes back a deed of trust which wraps the underlying. So there appears to be two deeds of trust on the property. One is the original, and the second is the larger wrap. The the reason a seller might want to do a contract is, or excuse me, all-inclusive deed of trust is they get a higher yield. They can set the interest rate on the entire amount of the loan. For example, if the first was 3% and the seller wraps it at 6, they're getting a yield on the underlying loan balance also.
That's fantastic for a seller, isn't it? And
It
still
is.
may be an advantage for a buyer, right?
Sure. Yes,
Yeah,
they can get the loan. Now there's risk too if the loan's called.
sure,
There's some risks, and insurance is an issue too.
sure.
That has to be investigated.
So, from a legal standpoint, what is generally the best way to do a deal like that? Is it a contract to sell or an all-inclusive?
It just depends. Now, there are loans that you can wrap and loans that you can't wrap. An FHA and a VA cannot be wrapped with an all-inclusive deed of trust
Right,
because title passes.
right,
The contract to sale, you could do those. It depends. You
right.
have to check with your title company. Not everybody would do them. We will not wrap VA loans
Okay.
or
So,
FHA.
so a contract to sell on an FHA, would you do that?
No.
Okay. Thank you.